Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at AMD.
If you find our talks useful, please consider subscribe, like, and comment underneath. And make sure to check out the VIP Algos link, which is below in the description.
Yeah, you definitely want to check that out. So let's just get right into the numbers today because they are staggering.
Right. I mean, imagine checking your portfolio and realizing that a legacy tech company, one that basically spent the last 2 decades known primarily for selling budget-friendly gaming chips, is suddenly running the physical infrastructure of the global AI economy.
It is a massive shift. I mean, completely unprecedented.
Yeah. On June 15th, 2026, AMD's stock just skyrocketed 8%. They hit a record intraday high of $558 a share.
Wow.
And they just crossed a staggering $900 billion market cap. But the most shocking part, I think, isn't the valuation itself. It's the fact that they achieved it by completely dissolving their old business model.
Right. They basically rebuilt their fundamental identity in real time.
Exactly. So today we are breaking down their Q1 2026 earnings and the strategic outlook, just to figure out exactly how they are breaking NVIDIA's monopoly. And, we want to see whether this valuation is actually built on solid engineering or if it's just pure market euphoria.
Well, it is rare to see a massive, entrenched, multinational pivot this aggressively. For years, the narrative in the semiconductor space was that AMD was eventually going to challenge NVIDIA in the data center.
Right, but it always felt theoretical.
Exactly. A lot of that narrative was built on just potential. But the Q1 2026 numbers finally provided the hard, undeniable math. I mean, they didn't just beat consensus estimates. They proved that their structural transformation is complete.
So let's dig right into that hard math, because it completely recontextualizes what this company actually does now. So in Q1, total revenue hit $10.253 billion.
Which was a 3.41% beat, by the way.
Right, and earnings per share came in at $1.37. But the real gravitational pull here, the segment that is physically altering the balance of power in Silicon Valley, is the data center.
Oh, absolutely.
It delivered $5.775 billion in revenue. That is a massive 57% year-over-year growth. So looking at those numbers, it really seems like they've essentially abandoned their old identity. The consumer PCs and the gaming consoles, they're taking a back seat.
Yeah, exactly. The data center is now their undisputed center of gravity. I mean, more than half of their revenue is flowing directly from the infrastructure that powers artificial intelligence and cloud computing.
That is wild.
It is. Their segment operating income for the data center reached $1.6 billion, and net income overall surged 95% year over year. What you're seeing here is a company prioritizing high-margin enterprise infrastructure over, low-margin consumer electronics.
And the velocity of this shift is really what's catching Wall Street off guard. I mean, forward guidance is predicting about $11.2 billion for Q2.
Which implies a 46% year-over-year growth.
Right, and they even announced they are on track to hit their 2030 target, which was to deliver over $20 in earnings per share 2 full years early.
Yeah, the acceleration is just incredible.
But here's what I don't get. Building AI infrastructure is famously one of the most capital-intensive endeavors in human history.
Oh, without a doubt.
I mean, fabricating these sub-nanometer chips requires facilities that cost upwards of $20 billion just to break ground. Yet they managed to generate $2.566 billion in free cash flow in Q1. That's up 253% from last year. How are they hoarding that much cash while fighting a multi-billion-dollar hardware war?
Well, this comes down to the mechanics of their fabless business model. And it's really become their greatest structural advantage. AMD designs the microscopic architecture of the chips, but they don't manufacture them.
Right, they outsource it.
Exactly. They outsource the actual physical fabrication to TSMC, the Taiwan Semiconductor Manufacturing Company.
So they are essentially just renting the factory.
Renting the factory, yeah. But more importantly, they are leveraging TSMC's massive balance sheet for all those heavy capital expenditures.
Oh, I see.
Because when you don't have to spend $20 billion building a new silicon foundry every 3 years, your debt load stays incredibly manageable. That operational leverage is what allows that $5.7 billion in data center revenue to convert so efficiently into $2.5 billion of free cash flow.
So they can take that cash and just pump it directly into aggressive research and development rather than pouring concrete for new factories.
Exactly. Or they use it for strategic acquisitions, which we're seeing right now.
Okay, well, let's talk about how they are positioning themselves in the market, because this really requires a shift in how you think about supply chains.
Yeah, it does.
So think about the massive build-out of AI infrastructure, like the construction of a new transcontinental railroad. For the last few years, NVIDIA basically owned the only steel mill capable of forging the tracks.
Right, a total monopoly.
Yeah, if you were a hyperscaler like a Google and Amazon or Microsoft, you had to buy from NVIDIA, and NVIDIA could charge whatever premium they wanted because you simply had no alternative.
You had to pay the toll.
Exactly. But now AMD has figured out how to forge highly compatible steel using a completely different process. They are stepping in as the industry's ultimate second source. But my question is, does being the second source just mean you're sweeping up the scraps from companies who are too small to afford NVIDIA's hardware? Or does it give AMD actual legitimate pricing power at the top of the food chain?
Oh, it absolutely gives them pricing power. And you really have to understand the psychology of enterprise procurement to see why.
Okay, unpack that for us.
So hyperscalers are terrified of single supplier dependency. If you're Microsoft, right, and your entire trillion-dollar AI roadmap relies entirely on NVIDIA, you have zero leverage.
Right.
If NVIDIA experiences a supply chain disruption or if they just decide to raise prices by 40% overnight, you are held hostage. By establishing a credible, high-performance alternative architecture, AMD is offering these tech giants something far more valuable than just silicon. They're offering leverage.
So the hyperscalers are basically purposely funding AMD just to keep NVIDIA honest.
Precisely. The switching costs to integrate a new hardware ecosystem are immense. I mean, you have to rewrite software, retrain engineers, reconfigure server racks.
It's a huge headache.
It's massive. But the hyperscalers are so desperate to break the monopoly that they are willing to absorb those switching costs and invest billions into AMD. That desperation creates organic pricing power for AMD. They aren't selling leftovers. They are selling supply chain independence.
Wow. And that structural independence leads perfectly to my next question. So they have $2.5 billion in free cash flow just sitting there. But in the semiconductor world, cash sitting still is basically a death sentence.
So you have to keep moving.
Right. So how are they actually deploying that capital to close the technological gap with NVIDIA?
Well, they're deploying it directly at the physical bottlenecks of AI computation. The most fascinating move here is their recent acquisition of a company called MEXT. They specialize in AI-driven memory optimization for data centers.
Let me push back on that for a second, though. If memory is just one component on a server board, why buy an entire company just to optimize it? Isn't that just a bloated, desperate way to secure parts because the supply chain is squeezed?
Well, it's not about securing the parts, actually. It's about solving the physics of the memory wall.
The memory wall.
Yeah, so here is how you need to visualize the current state of AI hardware. Modern GPUs, the actual processors doing the math, have become unbelievably fast. Think of the GPU as this massive 10,000 horsepower engine, but the data it needs to process the fuel is stored in the system's memory.
Okay, makes sense.
Right now, the connection between the memory and the processor is essentially a garden hose. So you have this incredibly powerful engine sitting idle, wasting time and power, simply waiting for data to be drip-fed into it. That is the memory wall.
Oh, wow. So you can build the fastest chip in the world, but if the architecture can't feed it fast enough, performance completely tanks.
Exactly. So by acquiring MEXT, AMD is bringing cutting-edge memory routing algorithms in-house. They are using AI to dynamically predict and route data through the memory architecture before the GPU even asks for it.
That's incredibly smart.
It is. And combine that with their new memorandum of understanding with Samsung. They did that to secure massive supplies of next-generation HBM4, which is high-bandwidth memory, for their upcoming MI455X chips. So AMD is directly targeting the exact physical choke point that NVIDIA is currently wrestling with.
And it's not just a technological flex, right? They are locking up the physical supply of HBM4, which blocks out smaller competitors from even entering the arena.
Right. It creates a structural moat.
And we are seeing the results of that moat in the contracts they're signing. There's a massive contract with Meta that was recently finalized for up to 6 gigawatts of instant GPUs.
Now notice the metric there. They are measuring the contract in gigawatts of power consumption, not in the number of chips or the dollar amount.
Yeah, that is wild to me. Why measure a compute contract in gigawatts?
Because power is now the ultimate constraint in AI infrastructure. Data centers are no longer constrained by square footage or the cost of silicon. They are constrained by their proximity to power grids and their ability to actually cool the hardware.
Right, because these things run so hot.
Exactly. So when Meta commits to 6 gigawatts of AMD infrastructure, which, by the way, is roughly the power draw of several mid-sized cities, they are making a generational, multi-decade commitment to AMD's architecture.
Incredible. And AMD is playing aggressive offense on the software side, too. They launched the Ryzen AI Halo developer platform, and that directly undercuts NVIDIA's equivalent DGX Spark platform by $700.
Yeah, they're using that second source flexibility to make it financially irresponsible for a developer not to at least prototype on AMD's stack.
It's a textbook market share grab. You get the developers familiar with your software ecosystem today, and you secure their enterprise purchases tomorrow. So we have the gigawatt mega deals, the MEXT acquisition solving the memory wall, and incredible cash flow. Let's pivot to the market reaction, because a $558 stock price doesn't just happen in a vacuum. You have Wall Street analysts rushing to upgrade the stock. Citi bumped their target to $575, Bank of America up to $560.
Yeah, the institutional sentiment is overwhelmingly positive.
Right. We even see billionaire Larry Robbins adding AMD as a core portfolio holding, not just a speculative trade. But beyond the company's execution, look at the macro environment right now. The recent geopolitical de-escalations have basically pulled the floor out from under global oil prices.
And that macroeconomic shift is a massive tailwind for a stock like this. When global tensions de-escalate, oil prices drop. When oil drops, inflation expectations cool down, which means central banks are much less likely to keep interest rates high. That lowers the cost of capital.
And when the cost of capital drops, institutional money just floods back into high-growth tech assets. But what I find fascinating is the specific physics of how AMD's stock moves in that environment. They have a beta of 2.49.
Which is incredibly high. So beta measures a stock's volatility relative to the broader market. A beta of 1 means it moves exactly with the S&P 500. A beta of 2.49 means that for every 1%, the broader market moves up in a risk-on environment. AMD's stock historically surges almost 2.5%.
It acts as a massive amplifier for macroeconomic optimism.
It really does.
But every massive amplifier creates distortion. So let's look at the friction here. As much as Wall Street is cheering, there is a very different narrative brewing in the retail crowd and the insider tracking data. Yes, there's been some insider selling, but the real red flag I want to dig into are these persistent Reddit whispers about vendor financing.
Vendor financing. Yeah, this cuts right to the heart of the quality of their earnings.
Break this down for us, because if I'm reading this right, the speculation is that AMD might be artificially inflating their revenue by paying their own customers to buy their chips. How does that actually work, and how dangerous is it?
Well, it's a tactic we saw heavily abused during the dot-com bubble, notably by companies like Cisco. Vendor financing is essentially when AMD extends incredibly favorable unsecured credit lines to a customer, allowing that customer to afford AMD's hardware.
Wait, so instead of a hyperscaler using their own cash to buy AMD chips, AMD is loaning out its own massive free cash flow to the customer and then logging that as a sale.
That is the speculative fear circulating right now, yeah. They're specifically regarding how AMD is converting these massive pipelines with companies like Meta and OpenAI. The critical question is whether the demand for the upcoming MI450 chips is entirely organic, meaning, the hyperscalers are paying out of pocket because the tech is just that good.
Right.
Or if AMD is sweetening the deal by financing the purchases themselves just to ensure they hit their aggressive market share targets.
Wow. If a significant chunk of that $5.7 million in data center revenue was basically bought on AMD's own credit card, then this $900 billion valuation is standing on much shakier ground than Wall Street realizes. Because suddenly, AMD isn't just taking on technology risk, they are taking on massive credit risk from their own customers.
Precisely. Because if those customers default, or if the AI boom cools and those data centers don't generate the expected returns, AMD is left holding the bag. Now, the institutional analysis characterizes this as unconfirmed speculative chatter for now, but it is the exact reason why the market is eagerly waiting for the Q2 earnings call. Analysts are going to be hyper-focused on the balance sheet, looking for unusual spikes in accounts receivable to see if there is any truth to the vendor financing rumors.
And that perfectly sets up the reality check we need to have. We've talked about the $900 billion valuation, the 57% growth, the mega deals, but we really need to rigorously examine the bear case here, which is entirely anchored by the fact that AMD is currently priced for perfection.
Yeah, let's look at the valuation multiples. AMD is trading at a trailing price-to-earnings ratio between 169x and 179x. Their price-to-sales ratio is a staggering 22.54x.
Let's unpack what a 170 PE actually means for the company's survival in the market. It means the market has already factored in all the incredible growth we just discussed. The early 2030 EPS targets, the $170 billion server total addressable market, the meta gigawatt deals. It is all already baked into that $558 price tag.
And when a stock is priced for perfection, The biggest risk isn't that the company starts losing money. The biggest risk is multiple compression.
Right.
If AMD hits a slight operational speed bump, say the HBM4 memory from Samsung gets delayed by just 3 weeks, or the growth rate drops from 57% to 45%, they might still be a highly profitable, growing company. But Wall Street will immediately compress that PE multiple from 170 down to, say, 80.
And the stock price could get cut in half even as the company's actual earnings continue to grow. There's absolutely zero margin for error. And there are actual physical errors and headwinds threatening that perfection right now. Their legacy gaming revenue is expected to decline by more than 20% in the second half of the year, while consumer PC shipments are getting squeezed by those exact same higher memory costs we talked about earlier. But the most glaring warning light comes directly from their own CFO, Jean Hu. She recently warned that as the new MI450 AI chips begin ramping up production in Q3 and Q4, gross margins are going to initially dip below the corporate average.
This is a critical point because it directly threatens the 170 basis point margin expansion they'd just fought so hard to achieve over the last year. A 1.7% expansion might sound small, but at this scale it translates to billions in free cash flow that funds their R&D.
Explain the mechanics of this margin dip to me, because if the new MI450 chips are their golden ticket, the exact cutting-edge product that secures their position against NVIDIA, why do they drag down profit margins? Shouldn't the newest, most advanced enterprise hardware carry the highest premium and the best margins?
It absolutely will carry a premium, but you have to understand what a product mix transition looks like on the actual factory floor at TSMC. When you manufacture a highly complex next-generation semiconductor, you are printing microscopic circuits onto a 300mm silicon wafer.
Okay.
Early in the production cycle, the manufacturing yields, meaning the percentage of chips on that wafer that actually function flawlessly, are relatively low.
So if a wafer costs, say, $20,000 to process, and only 40% of the chips actually work, the physical cost per functioning chip is astronomically high.
Exactly. You are spending a massive amount of capital to essentially throw away a lot of defective silicon early on. It takes quarters of intense engineering to refine that manufacturing process. As the yields improve and hit 80% or 90%, the cost per chip drops dramatically, and those gross margins will violently expand again.
So the margin dilution is just a temporary physical reality of pushing the boundaries of physics on the factory floor?
Yes, and what is fascinating is that the institutional market is completely ignoring the dying gaming segment and this temporary margin compression. The bear case is largely priced into the forward guidance. So as long as the data center keeps booming at that 57% growth rate, Wall Street is giving them a pass on the legacy businesses.
It really is a ruthless shedding of their past. They are entirely willing to let the consumer gaming business that made them a household name just wither on the vine if it means feeding the AI data center beast. So, synthesizing all of this, the comprehensive market analysis we've unpacked today gives AMD an 8 out of 10 bullish score. They have successfully established themselves as the only scaled, viable alternative to NVIDIA's iron grip on the industry.
The transformation is undeniable.
Yeah.
As we've established, maintaining a $900 billion market cap requires flawless execution. All eyes are now turning to their upcoming Advancing AI 2026 event in San Francisco on July 22nd and 23rd. This is where they will officially unveil the MI450-based Helios rack-scale systems. The general market consensus is framing this either as a swing trade opportunity, capturing the hype heading into that July event, or as a multi-year foundational hold to ride out the full manufacturing ramp of the MI450 over the next 3 years. But of course, we always remind you this isn't financial advice.
Exactly. You always have to weigh both the upside and downside for your own portfolio. But I want you to really think about the sheer velocity of this pivot. Think about how a single segment of a business enterprise data centers can completely cannibalize and rewrite a massive multinational company's entire identity, operations, and valuation in just a few short years. It is a stunning testament to how rapidly the AI revolution is demanding changes to the physical infrastructure of our world.
It is a phenomenal engineering and financial achievement. But I want to leave you with one final, slightly provocative thought to chew on. Looking past the 2026 horizon, we spent this entire discussion analyzing how AMD successfully broke NVIDIA's monopoly to become the perfect second source for AI infrastructure. But if AMD's ultimate strategy succeeds, and they flood the global market with highly capable, significantly cheaper compute power, Do they risk commoditizing the very hardware they are building?
Oh, wow.
By breaking the monopoly and forcing a multi-year price war with NVIDIA, could AMD accidentally destroy the massive 70% profit margins that the entire semiconductor industry relies on to fund its existence?
That is the ultimate innovator's dilemma. You spend years engineering a technological marvel to break a monopoly, only to realize your success might turn the most advanced hardware on Earth into a cheap, everyday commodity. We'll definitely be watching those Q2 earnings and the balance sheet closely. If you find our talks useful, please consider subscribe, like, and comment underneath. And don't forget, the VIP Algos link is below in the description. Thanks for joining us on Smart Wells with Joshua.